소개드리자면은 루이 씨는 중국 아시아 트레이딩 스페셜리스트이시고 도이치뱅크, 시티그룹, 미즈호든 은행에서 Derivative Structuring, Index Arbitrage 투자를 하셨으며 홍콩의 내수 아시아 캐피털 매니지먼트라는 헤지펀드에서 트레이딩 헤드도 하셨습니다. 이분은 2019년부터 민시 투자에 들어오셔서 저희 오프쇼 펀드들을 론칭하시고 그 펀드들 매니지하고 계십니다. 그리고 동로 교수님은 2016년부터 민시에서 투자 팩터와 시그널 크리에이션 리서치를 하셨고 지금 이제 마켓에서 애셋 프라이싱, 인베스트먼트 매니지먼트 등 많은 마켓 리서치 페이퍼를 쓰시고 상도 많이 받으셨습니다. 교수님은 미국 예일대에서 박사 학위를 받으셨고 지금 현재 런던 정경대 교수 및 영국 중앙은행의 컨설턴트이십니다. 그리고 저희 회사에서는 그리고 저희 중국 ESG 리서치 헤드이시고 아주 오늘 준비 많이 하셨으니까 좋은 시간이 됐으면 합니다. 감사합니다. Louis, over to you to kick off today's session.
Thank you very much, Stephen, for the introduction. Thank you, Kofia, and everyone on the call for joining us this morning. Hopefully, it'll be an interesting presentation for everyone about China and China Quant. I know Stephen just gave an introduction to myself, but just quickly again in my own words, I'm originally from Australia, but I moved to Hong Kong in 2006, 2007, and I've been trading and running portfolios in the China A-share market for the better part of 15 years. And I joined Mingxi in August 2019 to help launch and run our offshore business. And so hopefully, I can impart some of that experience in this call because a lot of changes have happened to the China A-share market since I've been looking at it. And arguably, in my opinion, Chinese equities are probably the most exciting they've ever been and one of the most exciting places to invest in terms of global equities. Now, we've got a lot to get through today. We've got a presentation that we'll go through. But before we get into it, what are we going to be talking about? Basically, we're just going to do a review of the last decade in China and where we are now, particularly the regulation. We're going to talk about the opportunity in China A shares, the quant opportunity in particular, and then the future of the China A share market. And it's important to remember that myself and Mingxi Investment Management, we are quantitative investment managers. We are not bottom-up stock pickers in respect to predicting earnings of a given sector. How we look at the market is more with respect to the structures, the bigger flows that are happening, some of the market microstructure, and inform our opinions on that. And I think that one thing to keep in your mind as you're thinking about allocating or investing in China A-share managers is that there's probably a good case to make for having traditional bottom-up managers and also systematic quant, more academic managers like ourselves. So that's a little bit introduction to what we're going to see today. But let's get into the presentation. If I can just share my screen. These are our two founders. Feel free to go to our website to see a more in-depth history of our founders. But when you think about Mingxi and what we're bringing to the table, just note that we're academic based. And so everything we talk about versus say more traditional asset managers or bottoms up guys or just, traders in general, we really have this academic background. And that's what and you'll see in our presentation that a lot of it is informed from that DNA. Okay, so let's get into it. What we see here is the MSCI China A onshore index. And this is the last 10 years. Okay, now remember, I started trading China in 2006. And so I've seen this evolution very much firsthand. And this is my personal opinion. For the last decade, I would break up the China A-share experience into two generations. The first generation from 2010, post-crisis to the beginning of 2016, which was after the deleveraging crisis in China, and then from 2016 to now. Okay, and I put some of the key milestones on the right-hand side there of the China A-share market to keep in mind. And so specifically, what would I highlight? 2014, the launch of Shanghai Stock Connect at the end of the year was incredibly important. Okay, 2015, during the deleveraging crisis of China, the change in the stock suspension rules, very important as a signal of where the government was going. 2016, Shenzhen Stock Connect, and really from 2018, there has been an incredible rate of liberalization and international investor friendliness with respect to the A-share market. Without question, from this period 2016 to 2021, or even 2018 to 2021, there's been more positive regulatory changes in the A-share market than there were for the 20 years before that, because the whole market is only 30 years old. Okay, and so some of the other key highlights there: MSCI inclusion, Starboard, China Export in Shenzhen, and they're all part of the same theme here, which is a growing institutionalization of the China A-share market and much more international investor friendliness. Okay, so this is the 10-year chart, but this doesn't really tell the story. And so if we move to the next slide, what I'm showing here on the left is CSI 300, the large cap index, and CSI 500, the mid cap index, from January 2010 to January 16. And on the right, it's CSI 300, CSI 500 from Feb 16 to August 21. You can see that in the first half of the last decade, it was very much a mid small cap driven outperformance. Okay, and obviously you can see if you're familiar with the market, in 2015, there was a huge retail leverage margin rally, which came crashing down in the end of 15 and beginning of 16. Okay, but from trading the market that whole time, China was really defined as a flat market, a multi-year flat market, very much reversal based. It just went up and down forever, big spike and then crash. But despite all the talk of China growth and emerging economy, etc., you really didn't see that reflected in the equity market in the first half of 2020. And so I put some of the highlights there. Very difficult to access, QFII restrictions, a lot of overhead trading with PBs, no global index recognition, so no passive flows, very, very high retail participation. We'll talk more about that later, but over 90% there. And then what I would say is a reversal factor driven market, and really a lot of playing around in mid caps. If you look at from January 2016, you can see that this is inverted to a degree. We're really seeing large caps start to outperform CSI 500. Now, you've seen that reversion a little bit this year, but with respect to the overall trend, it's very small. Okay, and what does this large cap versus mid cap outperformance represent? Well, it represents that growing institutionalization. It represents that growing passive flow. So, for example, this is an actual story. In 2015, when I was at Nezu, I was part of a group called the Asia Trader Forum, which is a group of buy-side heads, including the BlackRocks, the Fidelities, State Streets, etc., all the big passive managers. And during the 2015 crisis, when over half the Shanghai Stock Exchange was suspended, actually the Asia Trader Forum wrote to MSCI, to FTSE, and to CSRC and said, you cannot add the A-share market into our passive indices when they are able to do something like this, have half the market suspended. And that was a real wake-up call for the CSRC, and they engaged very directly with the Asia Trader Forum and much more directly with overseas managers, the likes of Fidelity, the likes of BlackRock and MSCI, to really make the A-share market much more tradable and investor-friendly for internationals. So 2015, 2016 was a key transition date. And this changing big cap outperformance is kind of a simple way to understand that. And so the highlights: CSRC more engaged, Shenzhen Stock Connect, really significant growth in the last 7 years, FTSE, Russell, MSCI additions, retail participation, still incredibly high by any global standards, but significantly down from 2015. And I think that retail will still be the dominant player for the next 10 years, but there is a growing institutionalization. That's important to note. And then you can see much more large cap driven growth. And on any given year, the factors that drive growth are a little bit more normalized. So we've seen momentum be prominent. We've seen, like last year, it was very much a momentum market. This year, a little bit more reversal. And overall, these two phases just show a growing institutional market. And maybe, not trying to be a macro analyst, but we're starting to see a systematic upflow due to the structural changes, not necessarily the earnings or the GDP prospects, because they were positive in the first half of the decade as well, but much more about the structural changes and the improved regulatory environment for international investors. So I think that's a really interesting point and quite positive for long-only allocation or even market-neutral allocation to the A-share market. Okay, so let's talk about the opportunities in China A-shares just as a market. You know, apart from this overall structural change, what makes it, in my opinion, the most exciting equity market, you know, outside of the US, let's say, and why I've dedicated my career to this market. Okay, the GDP growth is been a story, you know, for the last 15 years, arguably more important than ever now, as the Western economies really struggle to come out of COVID, and China has weathered COVID arguably much better than some of the others, particularly when you look at, you know, economies like Australia or the UK. US is starting to come back a little bit, but China is really coming through in terms of just consumption much better. And so that's a GDP positive thing to note. Size and liquidity is without question one of the most valuable points of the China A-share market. There are a number of emerging markets or Asian markets where you can deploy $50 to $100 million and maybe extract a certain amount of alpha. But the China A-share market is the second largest market in the world by turnover, okay? It turns over twice as much as the US market. In terms of deploying billions of dollars, which a lot of people on this call may be looking to do, or hundreds of millions of dollars, and expecting meaningful alpha and not having serious liquidity risks, there is only one market to allocate to, and that is the China market. And, you know, apart from being able to deploy a lot of capital, when you invest in markets like China, and there is regulatory risk, and we'll talk about that later, but in my opinion, regulatory risk can be defined as liquidity risk. And what China offers investors, whether you're in fundamental managers of relative small size or systematic managers, a good manager should be able to maintain a fairly liquid portfolio and thus be able to respond to those black swan risks. And this is something really unique to the China market because, you know, outside of the US and Japan, you know, where can you get out of a couple of $1 billion within a day, right? And this year, the China market's trading around 150 billion US a day. It's record volumes from from 3 years ago, it's up dramatically. There's an underallocation in the China A-share market, point 3. I think everyone understands that. More passive flows, more investor interest. There is a systematic flow into China. We'll talk, I've got this point a bit later, but you just saw that BlackRock announced 2 days ago that they launched their onshore mutual fund and raised $1 billion US. That might not sound like a lot, but it is impossible for overseas managers to raise money onshore. The onshore investors are quite resistant. For example, Bridgewater's here, UBS Asset Management are here, Russell are here. None of them really raise meaningful onshore capital. BlackRock closing $1 billion fund is meaningful and a real change in sentiment of the take-up of institutional management by the Chinese investing public. And then probably the second most important thing in my mind, outside of size and liquidity, is diversification. This is really relevant for managers such as in Korea or Australia, or even in the US, where a lot of the domestic managers are really concentrated in a few domestic stocks. For example, in Australia, it's huge allocations to domestic banks and mining. A lot of US now is in US tech. Okay, there's a huge concentration risk, and diversification really demands a premium. And China A-share, again, offers real diversification in global equities that you can deploy multiple billions of dollars as to. And so, you know, GDP growth and underallocation, I think, are stories that have been there for a while, but the increased size and liquidity and the diversification benefits, even more so now with kind of a decoupling from a geopolitical level, really speak to why people may consider a China A-share allocation now. Other opportunities, market breadth. A lot of people don't realize that in the onshore market, when I talk about the A-share market, I'm talking about Shanghai Stock Exchange and the Shenzhen Stock Exchange, not ADRs, not H shares. There's actually much more sector coverage. So you can build a much more robust portfolio in terms of risk and variance and potential upside. It's still not very well covered, 0.6, limited research availability and certainly very limited from the offshore brokers. I was doing some data work on offshore ratings last month, and it's still only a couple of hundred stocks covered by, the global houses, the Morgan Stanleys, the Goldman Sachs, and we're talking about, 3,500 tradable stocks in the A-share market. Valuation and factors are driven by the retail base. There's a lot of inefficiency that you can take advantage of there, particularly as a quant manager. And then 0.8 increased access. China geopolitical media and US China can be quite negative at times, particularly in the last 2 years. But I can honestly say that from a practitioner's point of view, from a trader's point of view, it's really one-way flow in terms of regulation, and that's more opening up more international investor-friendly policies. And for example, last year, they got rid of the QFII quotas. They're allowing single stock shorting using QFII inventory. And we'll talk a bit more about this later, but there's just, in the next 5 years, there's going to be a tremendous amount of liberalization in the China A-share market. There's really a growing opportunity. This is more academic. If you look at the MSCI China All World Index and you were to build an optimal portfolio, optimizing for risk, basically, China is incredibly structurally under allocated. As you know, you've got a 4.93% allocation right now in MSCI All World. To be optimal, the allocation needs to be 38.48%. This is something that everyone knows. This is the driver of increasing systematic allocation. It can be a case of 2 steps forward, 1 step back with respect to policy fears, etc. But this is the direction, and we've been talking about this in quite a few different ways. But there will continue to be a structural over-allocation into China over the next 5 to 10 years. This is a very specific point. I know if anyone on the call has ever traded index arbitrage before, which was where I did a lot of my career. In fact, I traded Korea index arb for many years at Citi. We actually had $1 billion portfolio when, I don't know if it's still the case, when Korea Post was a big player in the Korea market. And so looking at futures and understanding how futures and derivatives affect the market has really been a huge part of my career. And everyone talks about the China A-share market futures inefficiency. There's limited stock loan. It's allowed onshore, but it's very limited. And offshore is limited to the stock connect holdings. And what this means is that there is a systematic discount in the futures value versus fair value. Okay, so basically, the way to understand this simply is that if you want to short CSI 500 futures, you need to pay an implied 10 to 12% borrow fee. What people not everyone understands, and maybe everyone on this call does, but what a lot of people don't understand is that when you're buying the futures or when you're buying A-share inventory, you should be receiving that discount or that inventory value. So I've seen a number of allocators with positions in A-share ETFs, long positions where they're just getting the price return. But if you have the ability to trade with a Morgan Stanley or a Goldman Sachs and go long China swaps, you can literally today, you can get market risk-free outperformance by trading on swap with a global broker. So if anyone here wants to go long China A-share market today, you could go buy CSI 500, the mid-cap index, and you could get a guaranteed 12% outperformance per year because of the value of the inventory, because of the relationship with the futures market and discount. And so sometimes I see long-only managers charging 2 and 20 fees and getting 4, 5, 6% outperformance per year, when that's less than the risk-free rate. You could get than the market risk-free rate. You could do CSI 300 today and get 6% outperformance because the discount's quite large right now. And so one thing we're trying to do at Mingxia is actually break open that market. And so we're actually soon to be launching a fund, which is none of our fancy alpha, but we're just offering what is usually only available to large institutions, which is this outperformance product. And we're packaging it as a index plus income where you receive a fixed dividend. And so, long only, if you're investing in long only, you should be receiving a market risk-free uplift on their inventory because it's valuable and it has to do with the futures inefficiency. If you want to go more about that, please reach out to us and we'll discuss it later. Okay, let's talk about the quantitative advantage in China A shares. So we are a quant firm. I believe that quant absolutely leads the way in China, and these are the reasons why. Huge turnover market, 200% versus the US, 100%, 79% retail, right? And they're also in 35% of the stocks. But not only that, the reason why there's such a large quant opportunity is because the barriers to entry for the global players are so high. Whether you're talking about trading costs, language understanding, operational overhead, limited single stock shorting, very different portfolio risks and variance to optimize. The China A share market, the factors that drive it, the costs involved in the market microstructure are so extremely different to other global, quant markets, Japan and the US. For example, you can't even get the live book directly from the exchange. You have to reconstruct it, and even that takes a certain amount of expertise. And so what you've seen is that quantitative managers are really able to take advantage of this very high retail participation and the different factors that drive it, and also, with experience, are better equipped to handle the costs and the operational overheads that exist in the China market. So, so we'll see what that means. So let's look at hedge fund performance in 2021. Just keep an eye on the time because I want Professor Donglo to have time to speak. This is 2021 China A hedge fund performance. This data is from CICC. The blue bars are year to date, though I've got in orange here, and the light blue is July. Because as you know, what happened in July in China? Well, there was a regulatory crackdown effectively on education and tech stocks, and they were two very well favored and loved stocks by the industries by the fundamental community, and they got hurt very badly. And so you can see that year to date, according to CICC, fundamental long short guys, this is long short portfolios, were still up, but they obviously got hurt in July. I think this chart is actually quite generous. I heard some very large drawdowns from some large managers, but quant has been outperforming this year. What is important to highlight is that this wasn't the case last year. Quant underperformed fundamental market neutral managers last year, but is significantly outperforming this year. So this really speaks to the kind of point I made at the start, that when you're allocating to China, there is a spot for those bottoms up fundamental managers where you get these highly concentrated portfolios in these big thematic runs. But there's also very much a place for systematic portfolios, when we'll explain why, but a little bit more diversified, the different set of risks than fundamentals. And this year is a fantastic year to be allocated to quant. For your reference, the green there is our offshore market neutral portfolio. This is Mingxi's marquee offshore market neutral portfolio called Optima. When the market was down 8% in July, we were up 20%, right? We are really tuned to take advantage of high turnover and moving markets. And as of the end of July, our portfolio was up almost 35%. In fact, as we speak today, Optima is up almost 50%. That's our marquee offshore fund. Okay, so what has caused quant outperformance in 2021? And why is it interesting when you're thinking about allocating to China? Okay, well, there's 4 reasons: diversification, concentration, portfolio speed, and single stock shorting. I'm going to use examples from our own portfolio because that's the information that we have. But in terms of China systematic managers, in a very broad sense, these characteristics can be applied to the major players, including us. So diversification. I mentioned that fundamental managers, at least in my experience, generally are taking more thematic views. They're largely concentrated portfolios, less liquid, high sector, high single stock concentration. Systematic portfolios are generally not like that. We use an MSCI Barra trading model to break down our risk attribution and our return attribution. And this is our actual Optima factor attribution since launch last year. You can see that this is standard deviation on the left, months on the x-axis. Our overweight or underweight in any given sector moves around the zero. We don't take any systematic bets on sectors or factors. We're just trying to eke out more short-term alphas. Same here with the sectors. And so this is key when you're thinking about fundamental versus quant portfolios in the China A-share market, one general characteristics of quant portfolios is much more diversification of risk across sector and factor lines. Single stock concentration is a very important point. Again, in the same vein, we and other quants generally not to have big single stock positions. We actually have a max position size of 3% of LMV. And you can see that means at any given time, we'll have between 1,000 and 500 names in the portfolio, much more diversified. This has two important risks, or two important notes. You're not going to get those huge gains from a big winner in Maotai, for example, but you're going to have a much more diversified portfolio. And as importantly, a much more liquid portfolio. And so whenever I talk with the international community about risks, government risks, etc., I always bring it back to liquidity. And we'll speak about that in a second. If there's a government crackdown in some capacity, if there's some other risk, if there's a US policy which has an impact on the China A-share market, the most important thing you can have is liquidity and a manager that can get in and out of positions quite quickly. And so less single name concentration really assists with that. And that leads into this portfolio speed. Mingshu's portfolios, our peers, are generally more equipped to respond to a fast-moving market. And again, particularly important where there's a lot of regulatory risk. This is our Optima portfolio from April to July. You can see that the red shaded area is our long positions in CSI 300 names. And you can see that as of the 1st of July, those long holdings in CSI 300 reduced dramatically very quickly. This is part prediction, part reaction, but it's that ability to move quickly, which enables us to respond to policy risks and a changing market quite fast. In a systematic, there's, management, we build the engine room and then it runs relatively on its own. When you think about fundamental managers, there's going to be a lot of thought and emotion involved in cutting those positions, but we can act quite quickly. So again, there is a place for fundamental managers, of course, in the China A-share market, but equally, I think it makes sense to pair it with systematic managers because it is a very different source of risk and return. And then single stock shorting is the last thing I want to share. And I hope this is interesting because I don't think anyone's ever seen this sort of data before from a manager. And I'm sure no one has seen this. This is the actual offshore Stock Connect inventory that we get shown every day from our top 6 global PBs, right? So when people talk about the size of the Stock Connect market and what's available, if they're not sharing with you numbers that look like this, I don't think they're telling you the right thing. This is the factual availability from the world's 6 largest brokers in their Stock Connect holdings. So on any given day, we get shown around $15 billion of single stock short inventory. If you're in the market neutral space, you'll understand that shorting single stocks in the China A-share market is incredibly difficult. This 15 billion needs to be shared by everyone every day. And so you rarely get everything you want. It's largely concentrated in big caps. There's a huge amount of recall risk. You get recalled every day. It's a very expensive and difficult exercise to run a successful single stock shorting portfolio in the China A-share market. And it's even more difficult to run a fundamental long-term short, like a real structural short, because your inventory is going to get recalled at some point. You can't put a big active short on in a mid-cap name for a few months. It's impossible. You will get recalled. And that gives an edge to strategies like us, where we've got anywhere between a 3 to 5 day to 10 day holding period. We can capture that short-term alpha that is available in the short side of the A-share market, because that long duration isn't there yet. So this is a real key advantage for quantitative managers in the China A-share market. And what does that look like? This is the single stock shorting portfolio of Optima, our offshore market neutral, versus the CSI 500 price return index. And you can see that since we launched in March, we had a bit of up and down last year, but we've outperformed the short side by around 50%. Single stock shorting in the A-share market is arguably one of the most exciting sources of alpha in global equities right now. It's very difficult to trade. You need a lot of experience, and it's not very crowded right now. Very, very exciting space to be working in. With that, so that's my take on the China A share market, I'd like to hand over to my colleague, Professor Dong Lo. And as I mentioned, just to recap what I was saying, is basically, number one, China is going through another phase of incredible regulatory liberalization, despite what the headlines might say. Liquidity and diversification benefits are better than ever. And in terms of allocation, there is a real advantage to quant managers, not necessarily in replacement of fundamental managers, but in addition to them, because the tools, risk, and portfolio composition of a systematic manager like Ming-Shi are quite different to fundamentals. And as you see, the alpha right now is incredible in the China A share market for high quality managers like us. You know, we're talking on our offshore long only fund, we've got an information ratio of 5.9. In our market neutral portfolios, it's sharp ratios of 3+. We're really in a golden era for systematic management in the China A share market.